Hello everyone and welcome to the end of the end. The last chapter in the textbook that we will be studying this semester as part of your Principles of Macroeconomics course. And also the last week where you will have a quiz at the end and a discussion board post to make. After this, after we are done with the monetary policy week, we are going to just do review for the final exam. So that is what we have left after this chapter, after this week. We're going to have a review for the final exam, and then of course we are going to have the actual final exam, which is comprehensive. So the topics that will be on the final can be from any point throughout the whole semester, which is why I think it's important to set aside some time at the end for a review. But anyway, more about that in the video next week that will be dedicated to the final exam. Until then, let's focus on our last topic, a very important topic, monetary policy. Now you may notice that in terms of the book chapters, in terms of the textbook chapters, we kind of skipped back. We went forward to chapter 17 for fiscal policy, and now we're moving back to chapter 15 for monetary policy, because the textbook puts monetary policy right after the chapter on money. So a lot of the notions that we covered a while back when we did money are going to come up again when it comes to monetary policy. And I explained in my videos for fiscal policy, I explained why I wanted to go with fiscal policy first and monetary policy second, unlike the book which does it the other way around. And if you remember, the reason was simply that I believe fiscal policy is more straightforward and easier to understand because it's about taxes and spending. Things that we think about, well, I was going to say every day. Maybe not every day, but certainly a lot. Things that come up in politics, in political discussions, in campaigns, for when politicians run for office and so on. Taxes and spending are a topic of wide interest. Monetary policy, on the other hand, is about interest rates and the money supply. Much more esoteric topics that don't show up in political conversations, topics that don't show up on the news unless you watch, of course, specialized financial news. On the regular news, you're not going to hear anything about monetary policy. So of the two kinds of macroeconomic government policy, this is, I believe, the more difficult one. Which is also the reason why we're not going to go into a mathematical model of it in the detail that we had for fiscal policy. You remember all of that, the mathematical model that I gave you for fiscal policy. There is something like that for monetary policy as well. In fact, using the same formula, monetary policy impacts investment. So you have the whole Y equals C plus I plus G plus NE thing, and fiscal policy basically affected G, government spending, and C, consumption through taxes. Monetary policy is going to impact I, investment, in that formula. That's, in case you're wondering, that is what monetary policy does. It operates through investment in that formula. So in order to introduce monetary policy into that formula, we would have to introduce an investment function. You remember there was something called a consumption function. There is also something called an investment function. So investment would no longer just be a number, but would be a function, and then that function would depend on the interest rate, and then monetary policy would change the interest rate, and therefore change investment, and therefore change Y. Total national income, or GDP. That's not something we will actually be talking about, but I wanted to mention it for those of you who are curious about whether monetary policy can be presented or explained using the same formulas that we use for fiscal policy. Yes, it can, but we're not going to do that because what we are going to do is enough. You will see there's a lot of material as it is, so we're not going to add that on top of it. Alright, so having said all that, enough talk about what isn't going to be in this video. Let's start talking about what is. Okay, so monetary policy. In general, what is it? Well, in general, monetary policy is a type of government macroeconomic policy that uses money, that uses the money supply and the interest rate and therefore investment, as I just said, that uses investment to impact the economy. Its intended results, its intended effects upon the economy are not that different from those of fiscal policy. Fiscal policy ultimately is about shifting aggregate demand to the right, in order to get us out of a recession, or in order to reduce unemployment, or to the left, in order to reduce inflation, if inflation is spiraling out of control. So fiscal policy was about shifting aggregate demand to the right or to the left. Monetary policy is fundamentally also about shifting aggregate demand to the right or to the left. That is also the final end game of monetary policy. So it is another tool. It is a tool in the macroeconomic toolbox of the government. It's a tool that ultimately is meant to achieve the same result that fiscal policy does, but it achieves that result by different means, through an entirely different mechanism. So fiscal policy and monetary policy are two different tools that, if you're the government, you can use either one, or more often both to different degrees, to deal with macroeconomic problems. Remember, we have the goals of macroeconomics, and these two kinds of policy, monetary policy and fiscal policy, are the tools that we use, or that the government uses, to try to achieve those goals of macroeconomics. Remember, 3 goals: low unemployment, low inflation, and economic growth. Okay, so those goals are to be achieved using these two different kinds of policy. Now let's talk a little bit about some of the building blocks of monetary policy, some notions that you need to be very familiar with in order to understand how monetary policy works. First of all, the money supply, the notion of the money supply. You have to be familiar with this. What is it? When I say the money supply, what am I talking about? I am talking about the total quantity of money that exists in an economy, usually the economy of the United States, because that's the one we're talking about, at a given time. So the money supply is the total amount of money that exists, that we have at a particular point in time, like right now, or a year ago, or whenever. Now, as we mentioned in the video on money and in the textbook chapter about money, measuring the money supply is not necessarily a very straightforward thing, because there's a question about what exactly counts as money. Remember, we had M1 and M2, and I explained what those are. Those are two different measures of the money supply. By the way, yes, the money supply is always denoted by the letter M, capital M. That's what we use to represent the money supply. So M1 and M2 are two different ways to measure this concept, two different M's. M2 is always going to be larger. And there's actually more than 2. There are more than 2 ways to measure the money supply. We only talked about 2 of them in the chapter on money. But the point is that the size of the money supply is not necessarily something that you can just go out there and immediately find. It's open to interpretation depending on what exactly you count as money. Remember, from the chapter on money, remember that actual physical bills, banknotes, and coins are only a small part of the money supply. No matter how you count it, even with the most restrictive definition, even the definition that only counts a few things as money, even then, these things added all together, all of these things in the economy added together, are only going to be a small part of the money supply. The majority of money is not this. It is not bills or coins. Rather, the majority of money is data, numbers in a computer, no matter how you count it. And again, a reminder from the chapter on money, when we talk about creation of money, we often call it printing money. That's an anachronism. We call it printing money because 100 years ago, whenever new money was created, then it was literally printed. That's how you got more money in the economy. You printed more money. These days, since the majority of money is no longer physical, creating money isn't literally printing anymore. It's it's changing those numbers in the computer. It's crediting a certain account with more money. It's like edit, increase number. There you go. Now there's more money in the economy. There is still printing going on, of course. Money is still being printed. But these days, the printing of money has more to do with the U.S. Mint trying to estimate exactly how much of the money supply needs to exist in physical form. So the money supply is one thing, and the small part of it that is actually printed is another thing. And we're not going to concern ourselves with the institution that determines exactly how much money needs to be printed, because that has no impact on the economy. That's just a matter of bookkeeping, basically. Trying to figure out how much money actually needs to be physical. Okay, so that was a quick reminder about the money supply. It's the total amount of money in the economy. There are different ways to measure it depending on what you count as money. No matter how you measure it, physical printed money is only a small part of it. Most of it is virtual. Most of it is in a computer, data in a computer. All right. Another important notion that you need to keep in mind when talking about monetary policy. The interest rate, which is always denoted in economics with a lowercase r. Sometimes I've had students go for several weeks without realizing that this letter is how I write in cursive, a lowercase r. So yes, that is a lowercase r, in case you're wondering. Anyway, yes, the interest rate is always represented with this letter, lowercase r. And if I say interest, if I talk about interest in the context of economics, you know what I'm talking about, right? Well, I'm talking about interest on a loan. When somebody borrows money and then has to pay it back later to the bank or to any other lender, in a capitalist economy, not in every kind of economy, but in a capitalist economy, you pay it back with interest. In other words, you borrow $1,000, you don't pay back $1,000 a year later, you pay back $1,000 plus some other amount of money. Or, more commonly, you make periodic payments. You borrow $1,000, you pay back $120 10 times. Right, see what I did there? You pay back $120 10 times after you borrowed $1,000. So in the end, you end up paying back, in that example, you end up paying back $1,200, but not all at once, rather staggered over a period of time. There are many ways to do it, but ultimately, what all loans have in common in a capitalist market economy is that there is always some interest being charged in some way, whether it's in installments or all at once or in any other way, there's always some interest being charged. The borrower always ends up paying back more than they borrowed at the end. And this is essential for two reasons in a capitalist economy. Number one is inflation, of course. Remember, most of the time, during a normal period in a capitalist economy, most of the time, there is inflation. Hopefully not very high, hopefully low inflation. That's one of the goals, remember, of macroeconomics. But there is inflation. So $1,000 today are going to be worth more than $1,000 a year from now. Hopefully only slightly more, or in other words, the $1,000 a year from now are hopefully only going to be worth slightly less than $1,000 today. But in any case, there's going to be a difference in terms of purchasing power, in terms of how much you can buy with that money today versus in a year's time. Therefore, interest is necessary to account for that, first of all, so that the lender doesn't lose out by giving you money, $1,000 today, and receiving it back $1,000 a year from now. If the bank gave you $1,000 today and got back from you the same amount, $1,000 a year from now, then that would actually be a loss because of inflation, because the purchasing power of that money will be less when the bank gets it back from you. So that would be a total loss for the bank. That's unacceptable, so they have to charge an interest to cover that. But if the interest rate is equivalent to the rate of inflation, in other words, if the bank charges an interest such that the money they get back from you a year from now has the same purchasing power as the $1,000 that they gave you today, then that's a wash. Then the bank has nothing to gain from this. So in order for a lender to gain from the fact that they're giving loans, they have to charge an interest rate which is higher than the inflation rate. I say it again. In order for a bank to make a profit, or in order for any lender to have some sort of benefit, to have some sort of gain, some monetary gain, some profit from giving out loans to people, they must charge an interest rate which is higher than the inflation rate, so that it covers for inflation and then some. So that the amount of money that they get back from you at the end of the day, a year from now, can actually purchase more than the amount of money that they gave you. They give you $1,000, there's some inflation that happens, and they get back from you, I don't know, $1,200 at the end of the loan period, let's say. And that is profitable for the bank as long as that $12,000 can purchase more at the time when they receive it than the $1,000 could purchase at the time when they gave you that money. Okay, so interest rates exist first to compensate for inflation, and secondly, so that banks can make a profit. If we're going to have a capitalist market economy, right, if we're going to have a banking system that operates for a profit, as all private companies do in capitalism, then they have to make a profit, and this is how they make a profit, by charging interest on the loans that they give out. Okay, so far I don't think I told you anything you didn't already know, but here's the thing though. I didn't say interest rates here. I said the interest rate. I even wrote the in front of it. What do I mean by the interest rate? I mean, there are many interest rates, right? Every loan has a different interest rate. I mean, your student loans, if you have them, have one interest rate. Somebody's mortgage has another interest rate. Somebody's car loan has another interest rate. And a credit card has yet another interest rate. Credit cards are also a type of loan. So, you know, all sorts of different loans exist that are given out by banks or other institutions, and they all have different interest rates. So what do I mean by the interest rate? Well, this is an abstract concept in macroeconomics, which refers to basically the average interest rate in the economy. It's an abstract concept because you can't exactly just take all of the loans, take all of the interest rates that they have. You know, some have 1%, 5%, 2%, 7%, 3.25%. You can't just take all of those interests from all of the loans and just straight up average them, like in a simple average. It's not that simple because, of course, some loans are way bigger than others, so the bigger loans should have, their interest rates should count for more than the interest rates of the smaller loans. So it's actually pretty complicated to calculate this thing, the average interest rate or the aggregate interest rate in the economy. It's not a simple thing to calculate, but it is a simple concept to keep in mind. The idea is that basically we're going to pretend that all of the loans in the economy, all of the loans in the country have the same interest rate. It's a simplifying assumption, right? Remember? The basic thing about any model. The model is not a faithful representation of reality. Rather, it's a simplified representation of reality that aims to contain all of the stuff that is important and to not contain all of the stuff that isn't important. So in this case, by having a model with a single interest rate, what we're saying is that we're assuming that the fact that in reality the interest rates are different doesn't really matter. We're assuming that for the purpose of the macroeconomy, it doesn't really matter if different loans have different interests or if they all have the same interest rate. That's kind of a big assumption to make, and the different schools of economics might criticize it, but we're not going to go into that. For now, all you need to keep in mind is that we have this concept, the interest rate, and therefore in our models of the macroeconomy, we're basically going to pretend like all the loans in the country have the same interest rate. This is sort of like the average of the real interest rates that we're actually seeing out there. Sort of like the average, because like I said, it's more complicated than that. Okay, so that's what that concept is. All right. Something else that you should know. The concept of bonds, or a bond. This will show up in the textbook quite a bit, and in this lecture as well, to a lesser extent. So what is a bond in economics, in finance? Because it is a concept that is used in finance as a subset of economics. What is a bond? What are bonds? Well, basically, imagine it this way. Suppose that I took a piece of paper, and on this piece of paper, I said, I, Professor Tudorano, will pay the holder of this paper $1,000 on December 31st, 2021. Obviously, I didn't actually write anything on it, but imagine that I wrote that on it, right? I have this piece of paper, and I'm writing on it, and I'm making a legally binding promise that I will pay the holder of this paper $1,000 on December 31st, 2021. So it's like an IOU, essentially. I owe you $1,000. But it's an IOU without a specified addressee, right? I'm not saying I will owe you, John or Sarah or Taylor or whoever $1,000. No. I am saying I will pay the holder of this paper $1,000 on a specific date. Whoever that holder happens to be. Okay, that's an important aspect of a bond. So then once I've written it, what am I going to do with it? I'm going to sell it. I'm going to sell it. I'm going to be like, hey, I have this paper that says that if you have it, on a certain day to December 31st, 2021, you're going to get $1,000 from me. Okay? Who wants to buy this paper from me? Give me money now. In other words, buy it from me. Give me money now. And you will get $1,000 on the specified date. Now, obviously, I won't be able to sell it for $1,000. Because why would anyone pay me $1,000 now so they can just get it back in a year or in a number of months? No, that's not going to work. They will pay me less than $1,000 now so they can get $1,000 in the future, so that they can get their money back with interest. Remember. All right, so I won't be able to sell it for $1,000, but I might be able to sell it for $900, or if not that, then maybe $800. I'll be able to sell it for something. So that is how bonds work, essentially. They are promises, written promises from someone, usually a corporation or a bank or sometimes the government, to pay a certain amount of money. And that could be a promise to pay a certain amount of money all at once on a specific date, like the example I just gave. It can also be much more commonly a promise to pay a certain amount of money every month until a certain date, and then on that date, a big lump sum at the end, and then it's all done. The U.S. government at one point in the past even issued something called perpetual bonds, which were and are, because they're still valid, a promise from the U.S. government to pay you a little bit of money every month forever. And so that's also a thing. You can also have bonds that are conditional, basically that are like, I promise to pay the holder of this piece of paper $1,000 if a certain team wins the Super Bowl. That's a thing that can happen too. That's a thing that you can write. Those are very rare, but they exist. So a bond is a written promise from someone to pay the holder of this bond a certain amount of money under some conditions, all at once, or in installments, or if a certain event happens, or there are many variations. But that's the basic idea. It's an IOU. Now, as you may have guessed when I started talking about interest rates with regard to bonds, if you really think about it, a bond is basically a loan. The person writing the bond and selling it is essentially borrowing money. And the person buying the bond is essentially lending money, right? If I write a bond that says, I will pay you $1,000 a year from now, and you buy it from me for $800, so you give me $800 in exchange for the promise that I'll give you back $1,000 in a year from now, what has happened? What has happened is that essentially I borrowed money from you. I borrowed $800 from you, and I will pay it back with interest. I will pay back $1,000 in a year's time. That is what has happened. So a bond is like a loan. Now the difference between a bond and a loan contract is that a loan contract is normally between two specified parties. Me and Taylor, me and John, me and Angela, so me and somebody else are going to make a contract where one of us borrows some money from the other. A bond is kind of like that, but it's open-ended on one side, on the lender side, right? The borrower is specified. The borrower is whoever issued the bond. That's who's borrowing the money. But the lender, the one providing the loan, is anyone, whoever buys the bond. You're just throwing it out there and seeing who wants to lend you money. Basically, a bond is just that. It's waving a piece of paper around and going like, hey, I'm borrowing. Who wants to lend? I'm borrowing. Who wants to lend to me? Who wants to lend to me? That's what a bond is, kind of. And there's all sorts of things about bonds. For example, the fact that the person who originally bought the bond from you, the original lender, can then sell the bond to someone else. Why not? The bond just says that I will pay the holder of this bond a certain amount of money on a certain date, or under other conditions. But the holder of this bond doesn't have to stay the same. I could sell the bond to Angela, and then Angela decides that she doesn't want to hold on to it for a year, so she then sells the bond for some other amount of money to John, who then sells it to Taylor, who then sells it to whoever. And the person that ends up holding the bond when the date comes due is the one who gets the money from me in the end. But in the meantime, it could have changed hands any number of times. I can even buy it back. Why not? I issue the bond, I sell it to Angela. Angela sells it to Taylor. Taylor sells it to John. And then, hey, John, I'll buy that bond from you. Why not? So it is possible that the institution that issued the bond ends up being the one who holds the bond when the date comes due. In which case, of course, it doesn't actually have to pay it, or I guess it pays itself, that depending on the kind of institution that we're talking about. So all sorts of funny business can happen with bonds. And bonds are a big part of financial markets. Wall Street, what does Wall Street do? Well, Wall Street trades in stocks and bonds. We haven't talked about stocks, and we won't in this video. But yeah, stocks and bonds, those are the main things that are traded in financial markets, like Wall Street. So bonds are a big part of this. They're a very, very common way for institutions, for companies and banks to borrow money. Okay, so another important concept. Let's see, are we done with important concepts? No, there's one more. Or I guess two more. Well, one that's made up of a bunch of pieces. Anyway, the point is, the next concept that is important is the concept of a central bank. What is a central bank? Well, it's a type of institution that exists in almost every country. These days, since about the mid-20th century, so since the post-World War II years, almost every country in the world has had a central bank. Now, some are much older than that. For example, the Central Bank of the United States actually dates back to 1913, so way older. But especially in the last 70 years, almost every country in the world got a central bank. So these days, central banks are a fundamental feature of the monetary arrangements of the world. The world economy as it exists today relies on the existence of central banks, among other things. Okay, so every country has one, but what is it? Well, a central bank is an institution that acts like the bank for the banks. I'll explain that in a moment. It also acts as a regulatory agency, and it is responsible for a country's monetary policy. The central bank is the institution that actually does monetary policy. The central bank is the institution that controls the money supply and the interest rate, this abstract thing. Or if you want to be more realistic, the central bank is the institution that tries to control interest rates, plural, because in reality there's multiple ones, and the central bank is trying to sort of like control them all to varying degrees for the purpose of setting monetary policy. Okay, so the central bank regulates other banks, the banking system of a country. It does monetary policy, as we'll see, as I will explain. And it controls or tries to control the money supply and the interest rate, or more realistically, the interest rates. All right, now I also mentioned that a central bank is the bank for the banks. Now, what do I mean by that? What I mean by that is that when banks need a loan, when a bank needs a loan, it goes to the central bank to get that. Now, it doesn't have to. Banks can also borrow money from each other, but the central bank is something called the lender of last resort. When a bank, or actually other types of companies too, but especially banks, when a bank is absolutely strapped for cash, when it needs a loan, it needs money, and none of the other banks, none of the other private sector institutions are willing to lend to it, then it goes to the central bank for a loan. And in addition to that, banks also have accounts with the central bank. So just like you have an account with your bank, the bank itself has an account with the central bank. And the central bank is in charge of facilitating a lot of transactions between banks and sellers and companies and so on. It does a lot of bureaucratic stuff, in other words, behind the scenes. Now, in most countries right now in the world, central banks are a branch of the government. They're an institution of the government, just like, I don't know, the State Department or the Department of Defense or the Department of Education. They're essentially the Department of Banking. That's how they are in most countries, but not in the United States. The Central Bank of the United States is different from those of other countries. It's also older than most other central banks in the world. So basically, the Central Bank of the United States reflects an older model of central banking than what you'd see across most of the world. It also has a funny name. And I say funny because almost every other central bank in the world has names like the Bank of Japan, the Bank of England, the European Central Bank, and so on. Usually they're named the Bank of Country or the Central Bank of Country. That's very standard. But not here, not in the US. No. The Central Bank of the US is called the Federal Reserve. It's called the Federal Reserve, and we usually shorten that name to just the Fed. So the Fed, the Federal Reserve, is the central bank of the United States. And besides the fact that it has a different name than other central banks, it's also a partially government, partially private institution. So in that way, it's different from most other central banks that are simply a branch of the government. Now, what do I mean when I say that the Federal Reserve System, because that's what it is, it's a system, it's not just one institution, it's actually a complex network of institutions. What do I mean when I say that the Federal Reserve System is a combination of government and private sector institutions? Well, what I mean is there is an oversight committee, there is a board of directors that is overall in charge of the Fed, that is overall in charge of the Federal Reserve, and that board of directors is appointed by the President of the United States. It consists of 7 directors appointed once every 2 years. So it's not just one president appointing all of them, it's kind of like the Supreme Court in that way that, each president gets to appoint 2 directors of the Federal Reserve. Well, I mean, for each term, I should say, for every 4-year presidential term, a president gets to appoint 2 directors of the Federal Reserve. So overall, the board of directors represents a collection of past presidents. And it is this board of directors of the Federal Reserve that is in charge of monetary policy, that is in charge of trying to set the money supply, in charge of trying to control the interest rate, and so on. But besides the board of directors, there are also 12 regional Federal Reserve banks. And those ones, they cover different regions of the US. There is a very good map in the textbook showing you those regions. You might be shocked at how weird they look. They cut across state lines. Sometimes, a chunk of one state will be in the jurisdiction of one Federal Reserve Bank. Another chunk of that state will be in the jurisdiction of another Federal Reserve Bank. It looks weird. And the reason why, by the way, the reason why it looks so weird is because these districts, as they're called, the jurisdiction, the territory of each of the 12 Federal Reserve Banks, these were drawn up in the early 20th century, about 100 years ago. And they were drawn up based on where the big cities and the financial centers were back then. So it's a bit of a problem in that way. But anyway, the point is, the territory of the United States is divided into these 12 districts, as they're called, with each district having its own Federal Reserve Bank. And those lower level arms or branches or components of the Federal Reserve System, those ones have a leadership that is appointed by the banks, the private banks in their district. So the higher up, board is appointed by the government, by the president, or by successive presidents, and the lower down district banks, they are led by people appointed by the private banks. So that's the sort of the private sector, the commercial sector aspect of the Federal Reserve System. And those lower down district banks are responsible for, providing loans to banks, for setting common standards for the banking system. They're responsible for regulations of the banking system and so on. So not monetary policy. Monetary policy is the responsibility of the higher up board of directors appointed by the president. Okay, so that's why the Federal Reserve System is this combination of public and private, government and commercial. The higher up is government, the lower down is appointed by the private banks. Okay, and now we are done with important concepts. Let's get to the actual monetary policy itself. As I just said, the Federal Reserve System, or rather the Board of Directors of the Federal Reserve, is really the arm of government, to the extent that it is an arm of government, that is responsible for setting monetary policy. So, how do they do it? How does the Federal Reserve actually set monetary policy? To get an answer to that question, well, you're going to have to tune in to the next video.